Hello, Warriors. Thought I'd say hello to you guys. How's everyone doing today? How team, attendees,
Good morning.
Warriors. We have a little bit of a weaker dollar here today, and a couple things I want to go over. So anyway, this is pretty good lighting here, Blake, using some equipment that Steve sent me. But set it up after a year or so. Anyway, clear.
Congratulations, Dale. Way to go.
Anyway, I want to show you you're getting your money's worth.
I'm gonna have to give you another background too, the one that just has ForexAnalytix on it.
All right. Okay. Yeah. All right. The white background, I don't know, is as good because it, you get that shadow back there. But anyway, let's talk about how to not lose money and possibly make some. So first time I've seen Euro outperforming on a day when the dollar's down, outperforming cable. It looks like if we get through 107.5, this could extend. So, I wasn't sure, and I'm still not sure what path it's going to take. Are we going to hold here and, like Ellioticians are saying, there's a 5 coming, or are we going to correct here? If this happens, it's risk chance to regroup. And I just want to talk about risk and look at these two charts because it's changed. Leadership has changed. It's important to, let me turn this off. Anyway. Yeah. Okay. It's important to notice the change when it's happening. So, I mean, just look at the 2 dailies. Here's S&Ps. And Blake talked about it the other day too when we were talking about Apple. This is an important shift if it has legs. It led the way up and is now becoming a weakness, and they're trying to broaden it out. But pretty negative candle in NASDAQ yesterday. Apple right at that 9-day. I'm expecting a test of the breakout of the channel at 170, and we could pull back, and Apple could do that, and S&Ps could regroup as long as it holds like 42 and still make a surge towards that upper line in the 43s. We're also a very important time. Fed end of quarter coming up, summer beginning, the solstice, GAN stuff, possible shifts and trends. So I think that what we saw yesterday is an important thing to pay attention to in the market. And this too, this would really, I think, really surprise the market if you look at what's going on here in the 10-year. So, we had this back off and it held 360. And this is your demarcation line for rates, 360 and 390-ish. We start closing over 390, it's a breakout to the upside in yields. Most people I know were looking for lower yields. I mean, people I respect that, do good work, thought that we were going to get some, and they could still be right. I mean, we could fail at resistance and break, but they're talking like 280. The only thing I could think of that would cause that would be risk off. So anyway, I think this is important and a surprise. I think Yellen talked about inflation's still very important to defeat in her testimony, and maybe she's laying the groundwork for the Fed to hike. The market's acting like the Fed's going to hike next week. TLT, which, I've been talking about this confirmed low. We tested the breakout last week. We're sitting near last week's lows. Sure looks to me like we could get a flush. I don't know what it's going to be about. Maybe there'll be a downgrade. I mean, just because we got the debt ceiling done, I don't think it was Moody's. I think it was Fitch has his US on credit watch. So those are some of the things that I'm paying attention to. Silver's outperforming gold, but gold really took it on the chin yesterday more than silver. And I still think it wants this Blake's breakout line down here. So let's start off with Kman.
Hi, Dale.
Because
Hello.
I know you're real big on month's end. I know it's only the 8th, but quarter end is probably even more important than month's end, right?
It is. It is. It usually is, yes. And then it's your quarter end before the summer, so we may see some books being adjusted. But we will have the CPI data out before the FOMC next week, and it looks as if the market is trying to gear up towards a weaker print of that CPI in a way. But after we've seen the yields go up everywhere. It's across the board. It's not only the US yields, they've got up everywhere after those two relative surprise hikes by the RBA and the Bank of Canada. Yields are higher everywhere. And then we also have the start of, today is only the 4 and 8 weeks, I think, the start of the Treasury bills issuances, and that should keep yields underpinned for now as well. But the FX market is not really reacting to it since yields are going up everywhere.
Yeah.
Pretty neutral.
Yeah. Notice that yen is down with yields up again. The yen did rally back from its lows pretty impressively yesterday. But here we are. Oh, this is a candle.
In a bit of a triangle there, and a more medium-term trend line coming out just below 139, and then the top side is capped by that little trend line there around 140. What is it, 2025 or so? So it's yeah, you have to start a little later perhaps, but yeah, it's roughly there. It's just below. Just below 139, I have it. Bit of a channel that has been broken to the top side, and the support comes in around there.
They look like two different charts. The 10-year and the yen right now.
Yeah, because yields are going up everywhere. That. Then there's next week's Bank of Japan, where they have. They have upped their growth models a little bit as well. So all of that keeps it really in a range. And really next week, I think we are going to know a bit more, because then the market can safely say whether we are done on rates, whether we are going further, whether the Bank of Japan starts to move or not. So next week is going to be again an important one, I reckon. So until then, we may be relatively trading ranges, and with those expectations where CPI should continue to come off further, so create perhaps a little more divergence between the rest of the world, and especially Euro perhaps and the US. So the market is looking for clues right now, and with trading ranges, really. If you wanna, it's better to be a very short-term trader right now than a longer-term trader. And Steve also already hinted at that at the past few days. He's saying that, okay, this move can go on a little bit. We are looking for clues. We are looking for levels, and
we're paid to wait.
That's what you do inside ranges. You trade it intraday. You don't forget to take profits, even if it has the looks of going further. It always looks the most offered at the bottom and the most bid at the top. So that's there to
very important. Very important to ring the register more than ever.
Yeah, there to take your profits, and then if there's another move, then you jump on it again, and just while waiting for the bigger events to come to us.
Yeah. Okay, and that's next week. Fed. It's interesting though, these yields, I think there's a story, because I mean, do you know a lot of people that are, still bullish about yields over the past couple of months. I mean, most that I read after the, that failing rally up at 380 down here, they
Mm,
thought that was it, and we were
mhm,
going to take out these lows. So
yeah,
this is a surprise, I
yeah.
believe. And I remembered talking to Stell and putting up the daily, and I said, it was a weekly, and I said, well, tell me what you think of the chart. And then he started off with, talking about, his bias. And then I said, okay, cover up the title.
Hmm,
And he said, it looks like a bullish consolidation,
mm.
right? I mean, there's
Yeah,
nothing bearish about this, and unless we take out 330, it's there's nothing bearish about this right now.
no, if you look at the longer term, there's not yet a lot looking bearish about it. Um, if we really shoot through that, we can go up to 4% if needed, just because, sorry, because of the need of the treasury to replenish the
Yeah.
the cash
So
balances, and bond sharks will be more than happy to make them pay up for it as well, and that's where those flows can take the yields higher. But is it going to affect the dollar or FX markets a lot? That is my question a little bit, because yields is not always the whole story, right?
yeah,
The FX
yeah,
market knows that the treasury needs to do that. So
And hey, and good morning, Kman and Dale. And I
morning.
wanted to also mention, since you're talking about yields and you said it's, not always it's not always an FX story. I was actually just listening to a podcast well, within the last 48 hours, talking about positioning, and hedge funds are extremely bearish, and like a lot of leverage funds are shorting bonds right now.
Yeah.
And so
for
that's
weeks, months.
yeah, I mean, that's another factor, right? That, and it may not have a direct, the FX market may sniff that out as well. Anyway, I just want to throw that in too.
yeah, but you're right to mention it, because I said as well, there's so much money parked in the reserve requirement, in the reverse, in the repos, and in money funds, and the hedge funds are short bonds, so they could actually give the liquidity to the treasury in a certain extent, for what they need to do, and then take profit if the treasury pays up high enough for their money, right? So it's still an open question about what is really going to be the impact. I reckon it will keep yields, as I've said, past the once they would get an agreement on the limit. That was my expectation, was for yields to creep up because of that. And it seems like the hedge funds really front ran the event pretty well. So now we will have to see whether the treasury finds all the liquidity or not.
Welsh likes sort of the 98 area for a possible count to hold before we get a rally. And it's the same argument most people have. They're looking for a slowing economy. So they like the bonds. But and then you talk about the positioning. That's another contrarian bullish factor. And we'll see what wins. All of these things that traders look at are an avalanche of supply, and we're going to find out, I think, by the end of the month.
Yeah, I guess so. I think we'll know a lot more by the end of the month here.
Yeah,
I think we're going to know a lot more by the end of next week.
Day. By the end of F.A.C.E.
End of next week, once we get through inflation and CPI, and more specifically the Fed, right? I mean, so anyway.
Yeah, this is mind-boggling, kind of 14. So let's see, where were we at all-time highs? 14. So this is when the S&Ps were, 4,800. So, yeah, pretty amazing. We're here. We're not at 4,800, but there's, more complacency now than there was then. And I think there's more reason not to be complacent now than back here. There's a lot of, we knew the Fed was taking the punch bowl away in 21, and they were going to have a
100%
market,
agree with that. Yeah.
right? But we didn't have some of the issues that we're looking at right now, not just here, but China and everywhere. So
you know who I got a chance to talk to yesterday. I got a chance to talk to Eric Bosmajian from EPB Macro Research, and I have to say, Dale, you were like one of the first people to really find Eric. Back when he was like, I don't know, he was maybe like 13 or 14 years old, and now he's
Colonel Parker.
Seriously, I was having a conversation with him, and he's such a great macro. He's like one of those young macro guys that you can just see, like, from, in his career, like 30 years from now, he's going to be one of the really, really top economists type of guys. He's very systematic in his approach,
like a Mark Zandi turned out.
I really, really like him a lot, and I like what he has to say. He's extremely, by the way, he's extremely in the hard landing camp at this point, and which is interesting because so many economists right now have shifted from a recession to hey, maybe we'll just
no landing.
Yeah, maybe we're just going to enjoy a soft or no landing now, and he's very much in the, like, you guys don't know what's coming yet type of thing, which doesn't mean that he's going to be right. I'm just, he has a lot of
he has good company with Lakshman Akutang from the business cycle.
Lakshman, he's great. You had him on.
He's been around for quite some time, and he doesn't hedge. He doesn't hedge his opinion. Anyway.
The reason why I was bringing this up, and I think you guys have to watch on the Trader Summit site. I'll have that interview out for you later today. So you'll see it right here on Trader Summit, right in the front here. So make sure you check it out when it gets there. You'll see me tweet about it too. I'll tweet about it later today. The reason why I bring it up is he really discusses not only did we talk about, like, recession, where we're at in the cycle, what some of his proprietary data is telling us, but also how the housing market, the lags that we're seeing in employment and the housing, and why what prices are going to do here in the US. I mean, but you can extrapolate that I'm sure into different markets as well. It was a really intriguing conversation. I think you guys are going to really enjoy it, especially for those of you that think there is something a little bit worse coming down the pipe this year. And so you'll be in good company if you listen to what Eric says, but also if you are in the hey, we're not going to have a recession, or it's going to be a very mild recession. I think it's worth listening to what he has to say, because he's been spot on about a lot of the things that he talks about. So anyway, I think it's going to be a great conversation. I want to say, Dale, you did a great job finding him. So he's awesome.
It was just luck.
Yeah.
The harder you work,
says grandma washed her tinfoil hat and plastic bags to reuse. There you go. Good.
Oh my God. Goodness.
Hey, I want to talk about the S&P really quick here, and just talk about it technically, because I think it's important where we're at. And I can almost tell you right now, unless something dramatic happens between now and tomorrow, we're going to close above 4,200 and probably below 4,300. So I'm going to assume we're going to trade right here. I don't think we're going very far. We have Canadian employment tomorrow, which I think we should look at the Canadian pairs, especially following the Bank of Canada yesterday. We're going to talk a little bit about that. But as far as the market goes, I don't think there's any reason for us to go anywhere. Not because I don't think, oh man, this market's bullish, we should be going to 4,400 right now, or it's all going to roll over and we're going to break below 4,200 today. And here's the reasons why. I don't think there's any reason for the market to go anywhere ahead of the Fed next week. We do have the CPI on Tuesday. We have PPI on Wednesday before the Fed. And that data might alter what the Fed does, perhaps. But we also had, let's not forget, we had the Bank of Canada yesterday. They surprised us with a rate hike. Kman, since hopefully you're still here. Kman, what do you think about the Bank of Canada's moves, and should we be leaning into it? Because I know a lot of people, you saw the price action yesterday, right? You saw this is the big spike from, the Bank of Canada. That is a hawkish hike. You woke up this morning. I was asleep. Obviously, you woke up. People in Europe started just, buying Canadian dollars. Couldn't break it down. But do you think it's going to eventually break, or do you think it's going to break ahead of tomorrow, or do we need a strong jobs report out of Canada to do the trick?
I think we need. So there's two things. Later today, there's a Deputy Governor Baudry speaking. Right. Usually. There's always a Bank of Canada but speaking the day after the rate decision when there's no pressure. So him, and then tomorrow, perhaps the market is just waiting for the catalyzer or the kicker tomorrow in the jobs report to do something more with the Canada. And that can really go both ways, because we've been several times saying that, finally there must be some kind of weakening happening in job markets, and they've been holding up relatively well, right? The data in Canada, but the market may be waiting for this as a kicker to end the week on Canada, either break that 133 figure a quarter on the dollar Canada, or send some Canada crosses higher, or if you get a weak report, then price out the 0.25% that the market is now extra trying to anticipate for the Bank of Canada. So now the market is expecting that they would go to 5%. But if you get a weak report tomorrow, then we may have yet one of those other repricings to be done to the other side in the Canadian dollar. So and I reckon the market is really waiting for it.
I guess unfortunately we have to wait. It's that old. It's something that happened a lot to me in the Marine Corps when I remember being a young.
Hurry up and wait.
Hurry up and wait. I always had to hurry up, go somewhere really fast, and then wait for hours.
Well, when's the last time anyone saw a 7-month range, not to 9-month range in Canada?
Exactly.
Yeah,
it's going to be big.
It is.
You have like long-standing positions already in the Canada. Especially in dollar Canada. Why would you sell it here? And I'm not only saying retail traders, but even other people in the market. They will probably be saying that why do we sell it here and now? If it breaks below 133, we're probably going down to 130. So we'll still have the time to hit it tomorrow over the jobs report. If in turn the jobs report is weaker, happy I didn't sell it here, right? So.
Yeah, exactly. And it's not just let's just, since we're talking Canada and we're talking Turkey, let's let's go ahead and discuss a couple other things that might factor into this whole decision making thing. Let's go take a look at the Euro Canadian, which I have to say we're at horizontal support, 161% extension of that rally to that high. It is at the 161% extension. We're going to pivot right around support, and we're at wedge resistance. So A, you break out this way, or B, you break out this way, right? We're pivotal area. Canadian yen right at the previous support, current resistance right at the weekly, monthly 618, top of wedge resistance. Whether I've drawn it correctly or incorrectly, could be like that. People could be looking at it just like that too. So, it's right up against resistance. There's a lot of stuff up here. And then on top of it, didn't throw a monkey wrench into the whole thing. You go look at crude oil and the whipping between 70 and $75 in crude oil. It's been like the market's whipping boy, whipping girl, whipping something, just getting whipped around between $75 and $70. It's hard to, know exactly if we're going to break higher or lower based on what we're seeing technically. You may have some different views based on what OPEC's doing and, recession fears or whatever else you're thinking. But it's all very pivotal at these areas, right? I mean, it's not like a slam dunk. I know exactly what I should be doing at this moment with the Canadian dollar.
Yeah, absolutely. Yeah, I was just seeing like S&P Jordan is on the wires. He's still not giving up on inflation. It seems seeing second and third round effects. Inflation is more persistent than we thought. The Swiss rate relatively low. Not good idea to wait. So here we go. Euro Swiss back down. It tried to recover about 0.5%, but it's getting smacked down again. I'm sorry to interject that in your.
No, that's fine actually, because the Euro Swiss it's right up against the highs. I know a lot of people were. I was just talking to Chris Weston yesterday, and it's not just him. We were talking about City Tech also was looking at this possible double bottom. I know a lot of people are trading that, and it's kind of reversed a little bit. So yeah, definitely worth watching that. Jordan's talking right now, and boy, he put a little bit of oomph in the Swiss, didn't he?
Yeah. I mean, for as long as S&P is not going to give us the green light, saying that they're happy with inflation, saying that they're happy where yields are, the Swiss franc will have a tough time to materially weaken, because they are themselves leaning on or buying Swiss franc because they think it's combating inflation as well. They've said as much. So once they give us the green light, then the Swiss will materially weaken, I think. But until then, hard to see it weaken for longer than a couple of days.
All right, hey, Mike asked if
Euro's acting good.
What's
Coming out of here. Looks like it wants to come out of here for that 108.50. I'd love it. I'm a seller there.
On what?
That.
I'm sorry.
Euro. You were showing Euro, right?
Yeah. Mike asked about the Euro dollar. Look, the Euro is consolidating below the 38% retracement. I think that while we're below 108, this to me looks like, and I'm just gonna map it out for you. This is a quick ABCD move that will take us right back to 108, and this is where you're a seller. Okay. And I don't have any Euro dollar exposure, but I would be a seller at the 38% retracement if we can get it. And so, by the way, if you guys, if you're not in the Forex Analytics community, this is a perfect time for me to talk about this, because these are the types of things that we talk about here in the chat room. And I'm going to take you over to last night. It'll take me a little bit just to get over there. Because the last night, and this is Kman this morning, so sorry, I'm kind of Kman. Don't mean to bypass you, but I'm just kind of I don't know where I'm at. Anyway, you can see we talk about channel bottoms and ascending wedges, descending wedges. Last night I was like, hey, if the pound yen gets up to 175, I'm going to short it, and here's the reason why. We talk about all these setups in the Forex Analytics chat room all the time. And the Euro dollar is a prime example of, hey, we get an AB equals CD up to the 108 level. If you're a seller or if you're a dollar buyer, that's probably the place you want to be. That's going to take that dollar index probably towards flag support, probably the 38% retracement, where you could be a buyer down here around 103.20. So that's what I'd be thinking with the Euro or the dollar, should we get there as well. So just a few thoughts. Hey, Kman, I know never mind. I was going to jump into something, but we can do that in the chat room. We do have weekly unemployment claims coming out. So let me go ahead and pull up the data flash. This comes with Forex Analytics. I'm going to pull that over. I'm just going to keep it on the dollar index really quick, because I got 20 seconds or 30 seconds. So we're going to go to let's take a look at the S&P. There's it right in the middle, and whatever this is, I want to get rid of it, but let me get rid of this box. There's the S&P right here. There's yields right here. There's the dollar right here. And let's put the data flash right here. We're going to have jobless claims coming out. Yeah, just a quick view, 10 seconds from now, guys. And let's see if this weekly unemployment claims can move the needle at all. looking for 235,000.
Whoa, what's happening here?
Abracadabra.
It did the data come out? Do you see it? I'm looking around.
261.
261. Woo!
Oh,
Jobs
recession.
data is not so pretty. Not so pretty. We keep
Oh,
wondering
look what
if,
happened in 10 years.
yeah, yields are reversing.
Right
Dollar,
at
you can
major
see the
resistance. What a coincidence.
dollar yen has just slumped.
Yeah.
That's going to be the bigger mover there. Yeah. So really, and by the way, the
Oh,
dollar
the-
yen is going to
the
go right
yields.
down to its triangle support. If you're, by
Yeah.
the way, if you're in ForexAnalytix, we've been talking about this triangle. Support is
Yeah.
at 139. Resistance was at 140.20, and these are the levels that we marked up yesterday before we hit them. So you can see that we've been managing through that bullish triangle, which that's where it is. But we're going to be attacking support following that weekly unemployment
Yeah.
claims. Anyway, guys, I want to say thank you all for being here. Dale and Kman, thank you so much. I know Ryan's out of town enjoying his best life in Amsterdam, watching West Ham games. And I know you've been
Team won, by the
instrumental
way.
in being here. So is he in Amsterdam?
No, he's in Prague, and his team won, by the way, last night. So he's
Oh gosh, then that means he's gonna be
going to be
hungover.
on cloud.
He's going to be hungover today. All right. Thank you so much for filling in for him. And I know Stelios has been out of the Flow show too, because, you know, he has some personal things that he had to deal with this week. And so thank you so much for stepping in. Really appreciate you.
Oh, that
Dale,
reminds me, Blake, I'm going to
Yeah.
start following the Padres on the road. So San Diego Padres. Just thought I'd
That's
drop
all
it
you
on
got.
you live.
Yeah, the Padres.
So
You're a Padres roadie. Very
they
good.
want a senior citizen to be a bat boy. I guess that's very woke. So I'm going to just gimp out there and hand them bats, and I'll check in every once in a while.
All right, guys. Hey,
right,
I
man.
want to thank you all for being here, and have a great interview, Dale, with
All right.
Tomas.
All right. Thank you, Blake, Kay, Steve, the dream team,
Thank
my
you.
friends.
Thank you, mate.
My friends on the battlefield. We've been doing it for a while together, haven't we? We're like the 500.
Absolutely.
Like the
Oh,
500.
Steve is here. I pinged Steve
Yeah.
earlier on a message, and I didn't think he was even here. All right. Hey,
No,
Steve.
no, I was here.
He just kind of stalks in the background, waiting for people to call his name. Anyway, Steve, you just jump in anytime, all right, bro?
Okay, mate.
All right, and Thomas Malinen,
Hello.
how are you? How are you, Thomas? So
I'm fine. Actually,
oh.
you were using the war rhetoric, and it happens. I'm in Budapest now, which is just few hundred, well, not far from Ukraine. So
yeah,
I'm
what are
close.
you doing there?
We had a conference, Peace Forum, at
Oh,
the Matthius Cormenius Collegium. There was quite a nice line of speakers, including Jeffrey Sachs from Columbia University.
so after a lot of blood is spilled during a counteroffensive,
Yeah.
is that the aim of the counteroffensive, to force a peace after reclaiming territory? Is that what people were talking about?
The thing is that what Jeffrey Sachs basically stated, that Russia has been ready to negotiate peace for some time, but the Biden administration has not.
Interesting.
Yeah, that's
Okay.
really interesting. He told me, not me, us, he told that the 4 weeks into the conflict or the war, there was the peace negotiation in Turkey, Ankara, and they had a preliminary agreement, which was turned down by the Biden administration. They essentially said no. This is really interesting stuff, what he told, and I consider him to be so connected that he knows.
Okay. So you know, like others have said too, you know, like Joseph Wang, that it seems like the U.S. wants this war. Why don't you talk about why he thinks so, and you know, probably has something to do with it's almost the same approach with China. Almost seems like we want that conflict. Is it because America's in so much trouble, Thomas, that this is like Custer's last stand for hegemony?
Or something like that, because I think I read one piece from I think it was a year ago. Was it in a former columnist of the Washington Post or something like that? He stated that it's about the Eurasian development, with China, Russia, and Europe coming together and challenging the the US hegemony and all that.
He says
So,
it's not that.
yeah, well, Jeffrey basically, he didn't go into that, but in more detail, but he talked about the US hegemony and how they're trying to keep that. And he's been dealing with the politicians at the Hill for 40 years, so he's rather well connected, I would say. And I think he's great. We need critical voices at this time, I think. Because the European voices are mostly the politicians are saying we need more war, and it has never led to anything good in Europe.
Yeah.
So
okay, so I mean, let's get to your bailiwick. I know you pay attention to geo stuff, but first I want to ask you about the banks.
Yeah,
and since we talked, with SVB yesterday or the day before, Yellen said that there will be more consolidation in the banking industry. And to me, that's a buzzword for there will be more failures.
Yeah.
Tell me where your head's at on this banking
Well,
situation.
we're currently building a model based on the Great Depression, especially the Chicago bank panic in June 1932.
It was in June, huh?
Yeah, in June, between 20 and 28th of June, 1932. And we're building a model just to see. The thing is here now that what many don't understand, that we have kind of returned to the era where the banking panics are really the classical ones with the massive deposit outflows. Do you know, by the way, how big of a share of depositors tried to withdraw their deposits from the Silicon Valley Bank during the 2 days?
The percentage of accounts?
Yeah, percent of accounts.
I don't know, 80%.
87.
Okay.
We haven't seen such a run in any Western country since 33.
Okay.
So
let me ask you if the fact that at first there was going to be no bailout. I don't know what this is, a bailout. They're saying it's not a taxpayer bailout.
yeah.
What's the next step for U.S. banks? I've talked to guys like Hugh Henry, thinks that there's going to be a move to limit withdrawal of funds to a certain limit.
Yeah, that's possible, because the thing is that there is so much deposits, and the problem is that the banks do not have the liquidity to cover the outflows.
Yeah.
I don't have the figures yet, but the thing is that, like, most of the assets, they are regional banks, they have heavy exposure to the real estate market, and you cannot liquidate those assets.
No, you can't. So, people are just handing over the keys on what used to be trophy office buildings in major cities.
So you make even losses out of them. But if you have a deposit outflow, you need to liquidate it from the asset side. And if you have a lot of real estate loans, you cannot have it. The thing is that the bank term funding program, some banks have a lot of assets. You need to post collateral for it, but it's very unevenly distributed. I don't like to say the exact figures yet, but we run scenarios of the failures of the US banks, and they range from a mild recession of few hundred banks failing to a severe one with, like, let's say 2,000 banks failing. They are truly horrific.
So I think we only have 2,400.
No, you have 4,000.
Oh, okay, so
700 something, that are classified as banks.
Okay.
So that's in the FDIC database and all those. And it's a the figure it's
So do the equity markets just keep whistling past the graveyard, which the
Yeah.
graveyard is a banking crisis?
yeah, but we
When
knew,
do they care?
I think they have started to notice something now, because I think the equity markets will react when the recession, which is now coming, it becomes evident. Then they start to think.
When's that?
Well, it's difficult to say when it's coming, but
I want to know what hour. I want you to pull the WD Gann off for me, and you tell me he knew months in advance where wheat would be at a certain time of day. So
well,
you know,
we will sort of have a based on academic research, we will sort of have a very good guess which banks will fail.
all right. Well, you know, you brought up June in the 30s. You
Yeah.
know, I know an analyst friend of mine that I used to interview.
Yeah.
That it was important for him to get the message out. He's passed. He was looking for a July crash. He called the March low.
Yeah.
And June and July, kind of right around each other for there to be some type. And do they want this to happen for it to speed up the adoption of CBDCs?
Well, that's
the whole deal?
That's the worst case scenario, that they will when the CBDC of the Fed is launched, probably sometime next year, they will just let the banks fail.
Yeah, the Fed is a treasury now.
Yeah.
Because currency used to come from our treasury, Thomas.
Yeah.
But this is called a central bank currency, not a treasury department.
Yeah. That's how it is. And there's really the history of U.S. banking system is really interesting, actually. Like people argue that the deposit insurance, the federal deposit insurance, is what saved all, but there were several like regional private deposit insurance schemes that worked really well before that. So and the thing is that this banking crisis is probably the first one that is caused almost solely by the regulators, because they pushed massive amounts of deposits into the system, and also with the very low rates now that the loans went through the roof, and then they forced banks to buy U.S. treasuries
bonds,
at the peak prices.
Yeah. Exactly. So it's not like the Fed was unaware of what their policy of going from 0 to 5% was going to do to the books of the banks, right?
Yeah, and just consider that the yield of 2-year treasury went from 0.0 to over 4% in 2 years.
Yeah.
Just put that figure on the discounting formula and calculate how much is left from the value of the asset.
Yeah. 20%.
It's
10%.
not much. Well, it's a 20-fold rise. So basically, it's if we would calculate it purely, it would be worthless. But of course, it doesn't go like that. But
well, how about Europe? They were buying bonds with negative rates. It's got to be worse there.
It is worse, and well, we have the credit CIS already, and Deutsche Bank is just around the corner.
Okay, so is same strategy here. I think last time you thought there'd be a decent break in the market. I know you profess long precious metal position. Gold is holding up okay. So I do think right here's a picture. So, this is important. If we get through here, maybe there'll be a buying opportunity under 1800 one more time, because, can't this be the kind of thing when it gets rolling that everything's bad at the same time, because it's a liquidity crisis. And when that happens, it doesn't matter what the asset is. It's all about raising cash.
Yeah.
So if we have that kind of crash in the market, that it takes everything down with it.
Mhm.
And that's when, you know, you'd probably want, but you know, things like gold hold up better in percentage terms, a lot better than things like the triple Qs.
We are expecting the gold to go through the roof when this really gets going.
Yeah. Okay.
Because that's the traditional safe haven from the bank runs, but still there's the possibility of cryptos also rallying
Okay.
at that point.
All
I
right.
think
So we're having a pretty big move in yields today. So
yeah,
bonds are, you know, the, you know, to me, the important areas now are 360 and they actually could break out. Could we have this happen and not have a flight to quality, but have higher rates because of the supply? I mean, like TLT's 20-year paper where they could flush and they could be the cause rather than people looking for the bonds to cushion. They've led all the way down during this crisis, and compared to the stock market, when you think about it, this isn't much of a recovery in the bond market, is it?
it's not. No.
So you still bearish bonds and that we could make new high yields with all the supply coming in here?
Yeah, it could be
Yeah.
very well. I think the summary is crucial now because if you look at everything that has happened in the real economy, something needs to start to break during the fall. It's a
Can you
miracle.
believe that the VIX is 14? That's where it was in before the top in the market.
Yeah. Well,
14. Okay, in 2021, maybe even a little higher, 18.
yeah, but I think the question with the markets is now, where is the liquidity? What I read that it's not very high, and if it's not very high, then people are in a waiting pattern, and then you get these wild swings up and down.
I've noticed some air pockets
Okay.
in the trading because I watch it a lot, and you know, especially when things get a little fast, that my price quotes are all over the place. So
Yeah.
that may speak to structure. You know, they may wish they had market makers there
Yeah.
someday. Okay, so any new writings or anything you want to feature while you're here?
There's something on the few figures I would like to share
All right,
concerning the banks.
let me stop sharing and you
Yeah.
take over. There you go, buddy.
We have been doing trying to analyze the where is it now? There it is. So this is our, like, we do it every month. It's an outlook, and this is a special issue on the credit crunch. And these are forecasts, but these are like, you can throw dice with economic forecasts at the moment. It's the uncertainty is so massive. But considering the US is that if you look at these manufacturing figures, they're not good.
No.
They are like, the manufacturing recession has already begun.
Right.
And the services is kind of keeping up, but it's just, I think they're just manufacturing, just pulling everything down. But now we get to the point here, and this is interesting. This is the inflows and outflows of deposits and money market funds, and they are truly ships passing in the night. And the interesting thing is that this happens at the crux happens at the beginning of November already. Okay. So and it's not clear why this happens in November, except or late October. Is probably because something to do with the failure of the credit system and all that. There is like this is a signal of mistrust to banks, I would say. And the thing here is now, people need to understand that this, like, if deposits fall, you need to balance it, but this removes the ability of banks to give out more credit.
Yeah.
So when deposits go this way, it's not just a bank run issue; it's a credit issue. And if you look at the demand for commercial industrial loans, it has collapsed, and this started at late October too.
Okay.
So this is already, people talk about credit tightening or crunch. This is already going.
No one wanted it before there was a credit tightening cycle.
Yeah, yeah. And now,
Isn't that what that chart's saying? No one really wanted the credit
yeah.
before
But
we had.
this is flight to safety in the
Okay,
real economy.
all right.
So
And
that's what
it
it
doesn't matter what the rate is if you don't have credit
Yeah,
flowing.
it doesn't.
does
It
it?
doesn't matter. And this is one of the deepest, like, downturns or falls in this demand ever. So it's
Yeah.
yeah. So it's telling us something that, and then I think there is the credit failure of the credit says in October, or the near failure in October was
Yes.
kind of it pushed like everyone to this flight to safety mode. I think this is what this is presenting. So it happened then.
Okay.
And if you look at this, the M2 of US changed from a year ago. This is really exceptional also.
Yeah.
Massive increase and then just falling like a,
Yeah, like
so,
over Niagara Falls.
yeah. And this will have an effect. So I think we have the US is in credit tightening already, and Europe is too. But the possibility it will get into actual credit crunch or even credit depression when the recession gets going. Just think if there are bank runs. Oh, there's one more thing I want to show, and just to give a picture. I think I need to a new share here. There's somewhere.
You have any comment on China banning, their new policy of security over profit? And saying bye-bye to Micron and singling out other companies. You think they'll say Apple, to their population, don't buy Apple anymore?
I don't
Take down an American icon?
It's really difficult to,
Okay.
predict it. I don't know.
Well, I mean, did that guy talk about the US and China at all, or strictly Ukraine?
It was mostly Ukraine.
Okay.
So that was like, because that's the biggest thing here. But I show one more thing and then we can conclude with the Ukraine. This is a 4-week moving average of the growth of bank credit in the US.
Yeah.
And there is this heavy drop in March. So if the Fed would have not stepped in and stopped it, the US would be in recession already.
Aren't they going to continue to do that?
Yeah,
more
but the
failures.
thing is that how do they do that? They have like two nuclear options, which is that they restrict the withdrawals from banks, the deposits, which would be unheard of, or then they make a universal deposit guarantee. So these are highly exceptional, never before seen actions. And it tells you how bad the situation is.
Yeah, it does.
And like I've been telling here for some time, the perfect storm would be such that we would have a bank run, massive bank run. But then we would also have another escalation in Europe and possibly with China. So this is like the dangers, the risks are so massive currently that I think the equity market they are completely asleep.
Yeah. Okay. There's no geo risks priced into a 14 VIX. I'll tell you that.
No, nothing. It's
I've never
unbelievable.
seen. It's amazing. There are more things to worry about than there were a couple years ago.
Yeah.
And people are less worried than they were then.
Yeah, it's really
anyway. We were talking about that. So anyway, I guess the right thing. Do the right thing today, everyone, and tomorrow will take care of itself. That's a promise.
Yeah.
Right.
Yeah.
And it's always great talking to you, Thomas. I look forward to it. Isn't it amazing how fast 3 months or so fly by nowadays?
Yeah, it goes really fast. And they
Yeah.
and the developments in the middle, they have been rather massive. You know, when Joe Biden went on the television on was it on the 13th
Oh,
of March,
yeah.
and told US citizens that their deposits are safe, I was just horrified, because you don't do that unless there is a risk of nationwide bank run.
Yeah, I was, I count, you're talking about his, speech from the Oval Office, his
Yeah.
first speech, and underneath it said, crisis averted.
Yeah,
Yeah, that reminded me of President Bush's mission accomplished,
yeah, yeah,
right?
something like that.
So
Yeah.
I know. So yeah, that made me very nervous when I saw that.
Yeah.
So crisis averted. It's just like, you know, people were worried about Y2K and nothing happened from Y2K, but everything they were worried about from Y2K
Yeah,
happened anyway. You know,
yeah,
we had a bust in the market, we had 9/11, we had all kinds of things happen after the year 2000. I think that was the beginning of the new era.
yeah.
Um,
But I
Thomas, go
think
ahead.
I said this one last thing. I think we should consider, we have been like raising that possibility for, I don't know, 3 years now, that
Yeah.
could we actually be heading to a repetition of 1929 crash followed by a banking crisis. So I think we have to, that has to be acknowledged, the possibility that the markets are so overvalued concerning the macroeconomic fundamentals now that they have to correct in very heavy way in the fall. So I think this is something all investors need to ponder.
Okay, in the fall. Everyone thinks it's going to be in the fall. Why can't it be in July?
Well, it can, but usually the market activity is just, you know, lower, and summer, everybody's cheery on the summer. So unless
Yeah.
there's something major in the geopolitical front, I don't think, yeah, I don't know. I don't know why they are usually happen in the fall. I don't know. Is
Well,
there
I'm just
any,
saying it's, you know, it's too pat because that's what everyone's looking for. I think maybe it happens going into the fall and
yeah,
it's over by the, you know, the end of the year. Anyway, yeah, a lot of people saying October.
yeah,
I just, you know, we'll see.
we'll
Keep
see.
an eye out on July.
Yeah,
That's where my friend said he was looking for a crash, and he did a lot of astro stuff. So, and it was important enough for him to, when he wasn't feeling well, to get
yeah.
the message out to his followers. He called the March low, looking for a July crash. So,
Okay, yeah, that's it. Yeah, yeah.
yeah. So anyway, I'll name it after him, the Francis Boussier crash, when
Okay,
it happens. Okay.
yeah,
And
yeah.
I'll name something after you. I'll call the bank failures, bank closures. I'll call it the Malanin forecast of banking dissolution.
Yeah, okay.
Like
Well,
that?
thank you. Yeah, well, it works, I guess.
Okay.
Yeah,
The MT crisis unfolds in 2024.
yeah, something like
All
that.
right. All right. You know, I'm a fan.
Thank you.
All right, buddy. It was great catching up.
Yeah, likewise.
Take care, and I'll send you a DM on Twitter so we could be talking in the fall about what we just, you know, discussed.
Excellent. Let's do that.
All right, everyone. Thomas Malinin, follow him at MT Malinin. Check out his letter. Kind of it's a dose of reality that we all need now and then with the markets going parabolic. So that's a wrap, everyone. You could join the team in 15 minutes on the Morning Edge, and I'll see you to wrap it up, TGIF tomorrow. Thanks again, Thomas, and everyone for your attention. Hope we're adding value. Adios. Oh yeah, don't just count your pips, count your blessings.